Good afternoon. Thank you for joining us for AAM's Investment Outlook. My name is Peter Harmon. I am the marketing manager at AAM. I want to touch on a couple of things before we get started. First off, the presentation should last about 30 minutes. We do encourage questions, so please type your questions in the dashboard in the upper right corner of the screen. We are recording this, and we will make the recording available on our website. We'll send out a note once that's available. Also, we've uploaded the slides from this presentation onto GoToWebinar, so you should be able to access them there as well. So now I'd like to turn things over to our Chief Investment Officer, Reed Nuttall.
Thank you, Peter. I'm Reed Nuttall. I'll give you a brief recap of last year's markets, and then I will hand the ball over to Marco Bravo to talk about our economic outlook. And we'll go around the horn with the leaders of our sectors and trading teams and senior portfolio managers to talk about a variety of sectors and issues that we see in the markets. As always, as Peter mentioned, as you think of questions, please type them in and we'll get to them as they come up. In last year's outlook, we framed the discussion like this. The tax cuts were like stepping on the gas, while the Fed raising rates and reducing their balance sheet was like stepping on the brakes with the left foot. For those of you brave souls who have taught a teenager to drive, you may have witnessed that driving with 2 feet always results in an unpredictable result, oftentimes whiplash. We were cautious and, given tight spreads, advocated a move up in quality last year. That proved on point as the performance of riskier assets suffered in the fourth quarter as the Fed's braking began to bite. So this first chart is just a snapshot of returns through year-to-date through 2018, and then year-to-date through the middle of last week, through January 22nd. You can see that a number of sectors, U.S. equities, were down 4.39% in 2018, and then made all that back in the first 3 weeks of the year so far in January. So when we look at 2018, the economy hung in there. The Fed took a pause in 2017 and then began raising rates again starting in December of 2017, and they raised rates each quarter. And as we expected, the yield curve began to flatten, and in November of last year, it became obvious to pretty much everyone but the Fed that the economy was slowing. Then, after the Federal Reserve raised the federal funds rate for the 5th time in 5 quarters on December 19th, they also seemed oblivious to the markets, and during their press conference, they fumbled the ball, and after that, markets sold off sharply. The Fed has since walked back their indifference and indicated that neither future hikes or the reduction of the balance sheet is a done deal. And investors have seemed to believe them with equities up and credit spreads significantly tighter this year. As you can see from this chart, we're doing much better in 2019. So that being said, I'll hand it off to Marco, and he'll take us through our economic outlook for the year.
Thanks, Reed. We're starting on slide 6. After growing at around a 3% pace for 2018, U.S. real GDP growth for this year is expected to slow back towards its trend rate. Consensus estimates today have GDP growth increasing by 2.2% this year, really as the tax cuts and fiscal stimulus from 2018 begin to fade. Looking at the various components that make up GDP, as shown here on slide 6, the slowdown that's being expected for 2019 is really being led by weaker fixed investment, which includes business capital spending and residential investment. Recent declines in sentiment suggest that businesses and manufacturers are becoming less confident with the outlook. Additional risks that we see include a policy mistake by the Federal Reserve, slowing global growth, trade tensions, and geopolitical risks. Offsetting these risks, though, are a strong labor market and rising wages. Taken together, AAM views the risk to growth as skewed to the downside, and we're calling for growth to come in below consensus forecasts, although we're not expecting the economy to fall into a recession this year. Sentiment among manufacturers fell sharply to end the year, as seen on slide 7, which doesn't bode well for future business spending. Trade tensions, government shutdown, strong dollar, all reasons cited for the decline. More concerning on this slide is the steep decline in the new orders component, which tends to be a more forward-looking indicator. The headline index, though, is still above 50, which does signal expansion, although if this trend continues and the index were to fall below 50, that would increase the probability of the U.S. entering into recession. A major reason we don't expect a recession this year is the strong labor sector. Consumer spending, which represents roughly 68% of total economic activity here in the U.S., should continue to be supported by a strong jobs market and rising wages. As we see here on slide 8, the U.S. economy continued to add to new payrolls in 2018 at a healthy pace. Job growth last year averaged 220,000 per month, which was better than the 182,000 we saw in 2017. Although job growth and the unemployment rate tend to be more of a backward-looking indicators, we see no signs of slowing based on unemployment claims, which is more of a forward-looking indicator. In fact, for the week ended January 19, initial jobless claims fell to their lowest level since 1969. Strong job growth and falling unemployment has resulted in higher wages, which again, a positive for the consumer. As seen here on slide 9, the year-over-year change in average hourly earnings began trending higher early last year and is currently at 3.2% on a year-over-year basis. This represents the highest change level since 2009. The strength of the labor market seems to be attracting those who had given up looking for a job back into the labor force, as the labor force participation rate is up 0.4% since September. If we continue to see an increase in this rate, that would be another positive for economic growth. Which brings us to the Fed. Based on its most recent dot plot, as shown here on slide 10, the Federal Reserve today is projecting 2 50 basis point increases this year and 1 in 2020 before pausing. Most recently, Chairman Powell suggested that the Fed funds rate at its current level is closer to the neutral rate than where it was 3 months ago. And given the increased risk of slowing growth, both in the U.S. and abroad, as well as limited inflation pressures, recent comments coming out of the Fed seem to suggest they're going to be more patient with future rate hikes, with Fed policy becoming more data dependent. With Fed policy becoming more data dependent, we believe inflation and more importantly, inflation expectations will be the main driver of Fed policy in 2019. In addition to the monthly headline inflation numbers, the Fed will be looking at survey-based measures of inflation and market-based inflation expectations for signs that inflation is moving above its 2% long-term target. One of the Fed's preferred measure of inflation expectations, which is shown here on slide 11, is the 5-year break-even rate 5 years forward. As the chart shows, inflation is not expected to move much above the Fed's 2% target. In fact, is currently running below the 2% level. Our call here at AAM is for the Fed to raise rates 1 time this year, or a total of 25 basis points. This call is based on our expectation of slowing growth and inflation not moving much above the Fed's 2% target. In this backdrop, Treasury yields should move modestly higher from current levels, but we expect the benchmark 10-year Treasury yield to end the year below 3%. The yield curve between the 2-year and the 10-year, currently at around 15 basis points, we expect to remain flat, but we're not calling for the curve to invert this year. with that, I will pass it on to Elizabeth Henderson to talk about the corporate credit sector.
Thanks, Marco. As the green line in this graph shows, investment-grade corporate spreads were relatively stable in 2018, with positive excess returns through October. At that point, economic data started to disappoint, sending spreads wider as investors became concerned about a looming recession. As risk repriced, BBB bonds underperformed higher quality. The average BBB industrial widened to about 85 basis points versus the higher quality bonds, which is in line with the longer-term average. But lower-rated BBBs widened even more as they began pricing in the risk of falling to high yield. Fallen angels remained relatively low in 2018, but we expect that trend to pick up as growth slows and credit conditions tighten. After very strong growth for companies in 2018, estimates have been revised lower for 2019, given the weaker economic outlook for the U.S., China, and Europe. So we're expecting EBITDA growth of around 6 to 8% for non-financial investment-grade companies in 2019, which is a step down from the double-digit growth over the last 2 years. As you may recall, when EBITDA growth was in that mid-single-digit rate in the past, companies increased debt for the benefit of equity holders, largely by repurchasing stock or making acquisitions. We believe management teams will be more disciplined this year as the cost of debt has increased and uncertainty is higher. That means debt leverage should continue to modestly improve in 2019. It will be difficult for companies to improve margins this year, however, and we expect capital expenditures to grow only very modestly in the low single digits. Moving on to talk about supply and demand technicals, the demand side is always more difficult to predict, and this year is no exception. We had been expecting quantitative tightening to be more impactful this year, but we're already starting to see more stimulus from China and some patient language from the ECB and the Fed. This is supportive for risk assets and corporate bonds in particular. It should keep rate-sensitive investors and mutual funds and ETFs content, but a change in this outlook would be material since the cost of holding cash is not as onerous today. Foreign investors have been the other large buyer of U.S. corporate bonds due to the lackluster yields overseas. Unless something changes like the dollar selling off, we believe hedging costs will be a headwind in 2019 like they were in 2018. Therefore, our base case doesn't anticipate a big shift in demand. However, on the supply side, the outlook's more constructive. We expect less supply of investment-grade debt this year as companies, again, need to reduce debt leverage and banks have less to issue to meet bail-in funding requirements. So to wrap up, we don't expect technicals to drive spreads meaningfully tighter, so fundamentals and credit selection will matter. Our fundamental outlook is for credit metrics to modestly improve with elevated leverage, putting a number of credits at risk of being downgraded if their cash flow growth slows meaningfully. Our credit cycle indicators are not flashing red, but they are yellow due to the flatness of the curve and the tightening of financial conditions. So that leaves valuation. At year-end 2018, the corporate market was reflecting a 20% probability of a recession and a Fed that was done tightening. So as Marco outlined, our economic outlook is slightly more cautious for 2019, and we expect one more rate increase by the Fed. So based on how spreads have performed during prior Fed cycles, our fair value estimate for the corporate bond market is a spread of 150 basis points. So our bull and bear cases are shown on this slide. I would note that the bear case doesn't reflect a recession, only a heightened probability of one. And even though BBBs have widened, it's important to choose credits wisely since slowing growth and higher funding costs tend to highlight credit problems at this point in the cycle. So we prefer balance sheet sensitive credits and sectors, and I've highlighted them on this slide. So while we expect modest performance this year, we're better sellers today after the tightening in spreads this month and believe there will be better opportunities in the new issue market. So having flexibility to access both the secondary and new issue markets when there's volatility will be important and will be additive to performance. We expect security and credit selection to matter in 2019, and the same should hold true in high yield, and I'll turn it over to Scott to talk about that market.
All right, thanks, Elizabeth. So high yield started out really strong in 2018. In fact, back in early October, credit spreads fell to a level that was the low that we hadn't seen since the financial crisis. But with the year-end volatility, the market repriced significantly in the fourth quarter, with spreads ending the year 223 basis points wider from that October low that I just mentioned. And you saw this number from Reed earlier, but with the year-end spread widening, that pushed full-year returns into negative territory, and the market finished the year at a negative 2%. To put that in a historical context, 2018 was only the 7th time in the last 35 years of index data where high yield produced negative total returns in a calendar year. As you see on this exhibit, yields for the sector ended the year at 795, or a credit spread, which is shown here, ended the year at 526, which is a level that now exceeded the 5-year average. Given that, valuations for the sector are more attractive, as default rates are expected to remain around 2% in 2019, which is a level that remains below the long-term average of closer to 3%. Fundamentally, unlike the investment-grade market, high-yield issuers have generally deleveraged since 2015, as many of the commodity and energy-related issuers were forced to clean up their balance sheets. This can be seen as high yield is still experiencing a positive upgrade-downgrade ratio, and CCC rated issuers have declined to a decade low at 13% of the market. Further, interest coverage ratios remain high, and the maturities that need to be refinanced are manageable. On the technical side, technicals for the asset class are also supportive, as debt outstanding for the market has been shrinking since 2016. New issue supply in 2018 was $187 billion, which is down 43% year over year versus 2017, and that's also the lowest volume we've seen since 2009. In contrast, the leveraged loan market has been a funding alternative for high yield, with issuance of almost $700 billion last year, which is the second highest total on record. A negative trend that bears watching is that on the issuance side, acquisition-related issuance has drifted higher to about 20% of current volume. However, that level does remain below the long-term average, and it's well below the highs of over 50% last seen in 2007. Additionally, as you've heard from Elizabeth, headwinds for high yield could arise in a recessionary environment where BBB issuers are downgraded to below investment grade, which would increase supply in the market. So putting all that together, we believe this is still a constructive environment for the sector, as the higher yields overall improve break-evens and provide more downside protection, while fundamentals and technicals are supportive. We continue to believe that high-yield credit risk is best managed with an active strategy that emphasizes higher credit quality and diversification. And investors with a long time horizon and the ability to act as liquidity providers to the market during periods of volatility are likely to be rewarded. With that, I'm going to turn it over to Scott Edwards, who's going to give you an update on our views for structured products.
All right, thank you, Scott. I'm going to start on page, I hope that's 22. I can't see that far. When looking back at last year, structured products really performed pretty poorly, underperforming Treasury benchmarks across the board with the exception of asset-backed securities. We're expecting a little bit better year in 2019, and a lot of it has to do with the performance of the consumer. Looking on this page, unlike during the Great Recession when you had a highly levered consumer, the consumer balance sheet is in much better shape. Debt as a portion of GDP has dropped down to pre-crisis levels for the consumer, but in 2019, what we think the focus is going to be, as Elizabeth has already highlighted, is the fact that corporate leverage is getting to be more of a concern. So we think the focus in the market in terms of credit risk is going to be more on the corporate side rather than the consumer. The comfort with the consumer, we think, is going to really underpin performance in structured products, and we think it's going to lead to outperformance relative to the benchmarks and certainly better performance than we saw in 2018. I'm going to quickly go through the various subsectors of the market now. I'm going to start now with agency mortgage-backed securities. We've been really negative on the mortgage-backed security basis for a number of years now, and frankly, I don't see that changing in 2019. 2018 was another clunker of a year for mortgage-backed securities. The basis widened out 25 basis points over the course of the year, a fair amount early in the year, and then quite a bit late in November and December, although it did rally a little bit towards the end of the year. The main culprit for that is the Federal Reserve, which has been distorting the market for years. It's been buying up quite a bit of securities as they built their balance sheet up. That has been unwound. There is no reinvestment coming from the Fed. So over the course of the year, we're looking at about $160 to $170 billion of supply that normally would have been purchased by the Fed that has to find a home elsewhere. Traditional buyers, the banking system has been a pretty solid investor, but with some of the loosening of capital requirements, we don't think the banking sector is going to be quite as big as buyer as in prior years. Also, money managers, generally speaking, have been underweight mortgage allocations, and we don't see at these types of levels that changing much. So we're kind of looking for another year of wider spreads and think this is going to be one of the poorest performing sectors within structured products and are going to continue to underweight it in our portfolios. The close cousin, non-agency mortgage-backed securities, we're still pretty optimistic on the non-agency side. What we've got on page 24 is a representation of the delinquencies in the market. Delinquencies, the underwriting continues to be very, very good on the non-agency side and jumbo mortgage-backed securities, and we don't see that changing going forward. That credit performance is going to certainly support the marketplace. Housing, which has been a bit of a support, we think will be less so, but not problematic. We've been seeing growth in housing price appreciation, 5 to 6% per annum. We do think that's going to slow down to maybe 3.5% in 2019, but again, nothing that's going to cause any problems there. So I think the overriding yield advantage of being on the non-agency side is going to support that market quite well and continues to be one of our favorite picks. Moving on to CMBS, we're still, as we pointed out last year, CMBS tends to track, and what I'm using here is last cash flow AAA CMBS tracking single A corporates, and you can see obviously quite a bit of correlation there. As I mentioned earlier, we think the focus now is going to be on credit quality within the corporate sector, much less so than CMBS. So while we are going to track the corporate side fairly closely, we do think we're going to trade with a little less volatility and maybe trade a little bit better than the corporate basis. So that's just going to give us a little bit of an edge, we think, going forward, and do expect some fairly decent performance there relative to certainly treasuries and even, I think, relative to single A corporates. One thing that's going to help that market also is we've had, in terms of the consumer side, is also the delinquency standpoint within commercial mortgages. Underwriting continues to be very, very good, and that really limits the delinquencies we're experiencing in the marketplace. We think that continues into 2019. So from a credit perspective, another supporting element to the market, which again, I think is going to really help the performance of that sector. And again, this is another area we like quite a bit. I do think, as we've mentioned in prior years, we're going to focus a little more on single property transactions. We find them to be a little more conservatively underwritten than the standard conduit side of the space, so we'll continue to focus probably on single asset deals. Finally, just a quick comment on asset-backed securities. A good performer last year. We're going to continue to see that again this year. And again, a lot of it is just the consumer really is in much better shape than prior years. Here's delinquencies over the last several years within some of the consumer-oriented facets of the market. Student loan continues to be a problem, but looking at the more standard issuers within the asset-backed space, autos, mortgages, credit cards, we are seeing delinquents continue to trend down. Autos have come up a little bit, somewhat driven by the subprime space, but that's nothing in our mind that's problematic. So we don't see any real flags within the subsector, again, within the consumer. So we do anticipate performance from a credit perspective being really pretty good and expect another good year for asset-backed security. So to sum up, another good year, we believe, for structured products, the only weak spot being the agency space, but we should be beating Treasury benchmarks in 2019. With that, I'll turn it over to Greg Bell and Municipals.
Thanks, Scott. For the tax-exempt sector, we have a constructive outlook for the sector overall. Most of the constructive narrative is really driven by strong positives on both the supply and demand side. From the supply side, we're still looking at really positive effects from tax reform. Tax reform repealed the use of advanced refundings, and the lack of that tool being available resulted in about $100 billion less in issuance in 2018 versus 2017. When we look at supply technicals for this year, a similar story is going to develop. We're looking at about $375 billion in total issuance. That's up about 10% from last year, but that's still about 15% below the average issuance in the 3 years leading up to tax reform. In terms of refinancing activity, that's going to be we're going to see a jump there about 31% to $135 billion. The majority of that increase is going to come from the $20 billion in refinancing the taxable Build America bond issuance that came back in 2009. But again, even with this increase, you're going to see refinancings come in about almost 50% below the levels from 2015 to 2017. In terms of new money financing for infrastructure, we're expecting to see a modest increase there to about $240 billion. On the risk side of this, we could see this number become a lot higher if we see any federally sponsored fiscal stimulus from Washington. Given the gridlock there, though, it's hard to imagine any forward progress on that legislation. In terms of demand technicals, the market is expected to see another surge in maturities related to the record level of refinancings that occurred from 2015 to 2017. Those heavy reinvestment flows are expected to outstrip supply to the tune of net supply levels of negative $69 billion, negative $24 billion that's going to come here in the next within January and February. In terms of the household sector, that segment of the market is expected to remain fully engaged. Those investors that are in the highest tax bracket, their muni yield levels on a tax-adjusted basis are either comparable with corporates or well north of corporate yield levels. Some of the major headwinds going forward, though, in that demand category is volatility in mutual fund flows. If we see any sort of volatility and another surge in higher in Treasury rates, we could see another surge in outflows that occurred back in the fourth quarter of last year, where we saw about $4.2 billion in outflows. Another area of weakness in demand could come from institutional segment of the market. At the 21% corporate rate, tax-adjusted yield levels remain negative 10 years and shorter. The market saw about $40 billion in sales from banks through the first 3 quarters of 2018. We're likely to see some more right-sizing of portfolios in the institutional space. And that's where we are right now with our insurance portfolios. Again, with unattractive yields, 10 years and shorter, we are again looking at underweight in the sector and looking at better opportunities in the taxable space. One of those areas is going to be in taxable munis. That sector has experienced spread widening over the last 4 months. Spread levels there look very compelling relative to historical levels. And now I'm going to turn it over to Tim Sinichon. He's going to go through converts.
Thanks, Greg. On page 31, or 32 rather, we graphed 2018 convertible sector performance against a variety of market indices, and considering the volatility within equity, high yield, and investment grade corporate markets last year, the U.S. convertible market performed pretty well. 2018 provided an opportunity to witness the risk-reward value proposition in balanced convertibles as the stock market delivered strong performance through 9/30, followed by the substantial decline that we saw during the fourth quarter. For the full year, the Barclays convertible composite declined 2%, outperforming large and small cap equity indices and posting less than a third of the decline of underlying convertible equities. Positive convexity rewarded balanced convert investors as the corporate bond component held in relatively well, despite some spread widening in both high grade and high yield, as both Elizabeth and Scott mentioned. Each year we talk about the importance of new issue supply for ongoing convertible market health, and 2018 was an active and good year for issuance with over $50 billion pricing. Higher rates and rising equity valuations contributing to supply growth versus prior years. On the right side here, the donut chart, we see technology and healthcare related issuers continue to be a significant source of supply and something that bears watching, but we do note that the breadth of issuance is growing with a 30% increase last year in the number of deals pricing versus 2017. We're off to a slow start this year for new issue supply, but we'd expect that improved market sentiment and higher rates in recent weeks will get deal volume going again. All that said, similar to our expectation for straight investment grade issuance, if pockets of volatility reemerge during the year, we wouldn't be surprised if new deal flow falls short of last year's levels. Notably, 90% of new deal flow last year came to market without rating agency ratings, and roughly 60% of the market is unrated. So as we continue to work to optimize portfolio structure and the total return potential for client accounts, a maximum level of credit quality, flexibility, and guidelines will contribute to superior returns. When the convertible market sliced into risk buckets based upon equity sensitivity, one added favorable trend has emerged lately. The combination of increased new issuance, which brings new balance paper to the market, and the sharp sell-off during the fourth quarter, which disproportionately affected the most equity-sensitive names, has led to a greater opportunity set for balanced convertibles, which is where we focus. Our partners at Zasoff, as they step back and look at prospects for the strategy, view current market conditions to be as compelling as they've been in the last number of years. So with that, I'll turn it back to Reed Nuttall for some concluding thoughts.
Thanks, Tim. Okay, so just to sum up here, there's some optimism around the table as we went around. We're cautiously optimistic. We expect the economy to grow, albeit at a slower pace than what we've seen. We do not expect the yield curve to invert. As a reminder, a yield curve inversion is a signal that the economy is shrinking, and the market is beginning to price in a probability that the next move by the Fed will be to lower the Fed funds rate. So we don't believe that the yield curve is going to invert, and we believe that the Fed will pause, similar to what we saw them do in the middle of 2017 as they waited for clarity on the direction of the economy. Valuation and risk assets are a bit more attractive today compared with last year, but because of the strong run-up we've seen in January and the current volatility in the markets, some degree of caution is warranted. We took advantage of wider spreads in December and early January, but the exceptional performance during January, frankly, gives us pause. We recommend keeping some powder dry to take advantage of what we believe will be a year with some volatility caused by factors outside the U.S., European economic slowdown, Chinese tariff negotiations, and a variety of kind of global factors. So we expect that kind of volatility throughout the year, but we do expect that we'll finish on a positive note. And once again, to reiterate what Elizabeth said, individual security selection and a focus on risk will prove to be the right call in 2019. So that's all of our prepared remarks. If anyone has any questions, we'd be happy to discuss them here now. I don't see any popping up there. We appreciate our clients and our visitors who have joined us on this call today. Do we have a question?
No.
All right.
Thank you.
But we're glad that we're able to be here for you and answer your questions. Certainly, if you have any questions going forward, anyone around this table or we'll be happy to get on the phone with you and your portfolio managers to discuss our outlook, and we thank you for joining us.